There we are. Right. Thanks, everybody, for joining us. Apologies. I'm going to stand through this if that's okay, because these chairs are not desperately comfortable to sit on, so anybody else that feels standing, they can as well. So we're talking today about transitioning to a new financial world order. And I'm Heather Buchanan. I'm co-founder and chief executive of Bankers for Net Zero. We convene the UK country chapter of the Net Zero Banking Alliance, and we're really focused on that interplay between the commitments that financial institutions have made in order to, particularly around decarbonising their financed emissions, and that intersection of policies. We know that actually we're fundamentally undergoing quite a substantial kind of change in how we value things and value risk and value. And so I'm delighted to have a fantastic panel for you today, and I'll just go through and probably just ask everybody to introduce themselves, where they're from, and give us just a bit of an opening remarks about where we are in this transition, and we can go from there. So I'll start with David.
Yeah, thanks a lot, Heather. It's really great to be here and see a number of familiar faces. I'm David Carlin. I founded the Risk Center at the UN Environment Programme's Finance Initiative, UNEP-FI. I also head up an advisory called Cambium Global Solutions and work across a number of threads on sustainable finance, from net zero banking to transition planning.
Amazing. Thank you.
Hi, I'm Constance Chalcha. I'm BNP Paribas Chief Sustainability Officer for both the corporate and institutional banking side of the business, as well as the markets activity. And I've been spearheading sustainable finance for large corporate and financial institutions since 2014. So it's been a long and interesting journey.
I'm Richard Manley, Chief Sustainability Officer of CPP Investments. That's Canada's largest pension fund. We invest globally. About 85% of the balance sheet is invested in equities, private and public, 15% credit, 20% debt. You've all done the math. That's 120%. The fund is levered, quite unusual for a pension fund to be levered. 55% invested in private markets, 45% in public markets. The reason I say that is if you're going to have more than half of a pension fund in illiquid equity, you've got to get sustainability right. So we're very, very focused on that. And other jobs I have, I currently am the chair of the ISSB Investor Advisory Group, was a former member of the TCFD, and I'm also actively involved in UK Treasury's transition planning. The only thing I'll say on that is the reason we're focused on this is we don't believe we can get the real economy or the financial economy to net zero unless we get the right information in the right people's hands.
Absolutely.
Hello everyone, my name is Christopher Morris and I'm the token scruffy entrepreneur and early stage investor on the panel, with most things here well above my pay grade. I am co-founder and managing partner at Sustainable Ventures, where we do everything we can to help early stage climate tech entrepreneurs to succeed. Over the last 13 years, we've launched 6 direct spin-outs of our own. We've made 48 third-party investments, hopefully hitting 50 this week. And we also currently provide dedicated workspace to 115 climate tech startups here in London, with further hubs coming in Manchester and Glasgow over the next year. And in total, we've now supported over 700 climate tech startups through our public and privately funded programs and support arm. And delighted to be here.
Amazing, thank you. So I thought that we would kind of kick off just around the economic opportunity here. Everybody's saying that net zero is the biggest opportunity that we've got coming our way. And I certainly, over the last few years, have seen attitudes to this change and a real acceleration in private finance. So, David, UNEP-FI provides sustainability leadership to more than 400 financial institutions, with assets well over 80 trillion headquartered around the world. How do you find that attitudes towards net zero and sustainability have changed over the recent years? And do you feel that we're on the right side of that curve?
So I think it's, on the one hand, from a progress standpoint, remarkable that net zero isn't just mainstream, it's taken as an expectation. Major institutions, major nations that don't have some sort of commitment to net zero are the outliers. I think it was Climate Action Tracker did the estimate that about 89% of global emissions are covered by countries with a net zero commitment. Now we have within the major financial institutions a majority of the major European and American banks that have stepped up to make these commitments. So that is incredible that the terms of the debate have changed. I think on the other hand, what we've seen is if net zero was a big pool party and people started jumping in because they saw their friends in the pool, well, now they realize, one, the water's a little bit cold, and two, you better know how to swim. And I think that this is the action phase right now. This is really where we're at, and I think you're seeing that the road to net zero, it might look fine on a slide, but as anyone who's ever gone skiing and has, taken on something perhaps that was a little bit more adventurous than they were expecting, once you get your skis over that edge, it's a different story. So you can see it on a map, but I think what we're really seeing now are some of those, not growing pains, but implementation challenges. And so clearly we're not moving fast enough, which means that this level of challenge is only going to increase, and that's why we really need both political as well as corporate and financial leadership at this time to not only maintain the strength here, but really to keep focused on that future, because I think one of the mistakes we see is inconstancy. If we backtrack and then decide, oh, actually we should have done net zero, it will be too late. So we don't really get a redo here.
That's amazing, and I love the pool party analogy. I think we're going to have to use that a bit more. And Constant, just in terms, so BNP Paribas obviously in the UK more kind of sit in the investment side. Obviously you've got a strong retail presence elsewhere. So how are you finding, I guess, engaging with customers on this? And why do you think that we're probably not seeing the level of investment that we really do require to get the whole of economy transitioning?
I think the topic is indeed to accelerate transition. There's not enough happening. And Europe has been very focused on delivering the green side of things. But today, transition of hard-to-abate sectors is equally important. So what we've been advocating in the last few months is really to try to find a route which is not only spearheading investment on green energies, but also finding ways to facilitate investment in transition. And together with the Loan Market Association, we've been working on a working group to define what would be a transition label that would suit investors, issuers, but also financiers. And on the investor side, investors are realizing that to deliver performance, financial performance, taking a company which is a very brown company, heavy emitting, and enabling them to be less brown, to really decarbonize their operation, is a crucial and very often leads to better financial performance than a pure green player. So investors are highly motivated, but they want credible plans, and they want to be sure that their investment is going into the transition capex. So we've been advocating for ring-fest transition labels that would be kind of the equivalent of a green label, use of proceeds driven, but really channeling capital towards clear transition, use of proceeds, clear transition investment.
Amazing, thank you. And Richard, that kind of follows on nicely in terms of an investor's perspective in this. And I guess one of the things, so I guess first and foremost, what are your priorities, opportunities in terms of stewardship and how you work with companies that you're invested in? But I'd also probably just like to say, particularly on this transition piece, how do you also communicate that to people who've invested funds with you? Because I think that's something that if it's just investing in green is kind of an easy optic, as it were. But investing in the transition, how do we start to communicate that that's an important part of this process?
So maybe just a quick double click on CPP, because it's a little bizarre, but nobody invests with us. So Canadians effectively are required to contribute to the CPP. It's a national pension fund. We effectively are the asset owner and the manager, and our mandate is enshrined in an act of law that says basically maximize returns without undue risk of loss. So some might say, God, that sounds like the ultimate fiduciary. Maybe they don't even have to consider sustainability. The reason we do consider sustainability is we're of the view that making more informed decisions is probably going to yield superior outcomes, and that sustainability is a dynamic and emerging risk of this new century, and that the companies we invest in, we want them to manage it, and we, in our investment process, seek to manage it. I'm going to try, if I can, Heather, just to tie the last couple of points together, because I think we are starting to get to a place now where finance is on a better footing to support the transition. I do worry that 2.5 years ago, 3 years ago, in the run-up to COP26, we were, I'm going to say, seeing stakeholders seek to weaponize finance to pursue a divestment agenda. And the reality is, just as you can't cut your way to growth, you can't divest your way to net zero. And I think the challenge of that was we really did see a mantra about reduce financed emissions. The challenge of that is the only way to reduce financed emissions is actually to slowly sell the greyer parts of the economy. The real issue I think that we wanted to see was that we empower finance to finance emissions reductions. It's remarkable. 3 words, just change the order. Reduce financed emissions, divest. Finance emissions reductions, invest. And we're slowly getting to the point now where the guidance is starting to change. We've seen some recently updated guidance from the investor coalition around climate change investing to say, no, it is right now to be seeking to bring emissions onto the balance sheet to finance the ability of those grey sectors to decarbonise themselves. Now, CPP has been doing that since we unveiled our commitment to net zero. But a few things that I think will become a theme of the panel maybe. There's 5 things that investors don't control. I think you've just heard that lenders can negotiate covenants and impose conditions on borrowers. Investors really only have governance rights to appoint the board and hopefully then hold the board to account. But one of the things that we basically said the 5 things we don't control are shaping consumption habits. If everybody insists on, basically making carbon-intensive consumption habits, it's going to be very difficult to decarbonize. We don't control the technology stack, but we can clearly finance its continued innovation. Market infrastructure, that's reporting standards and carbon markets. Next is companies delivering. We don't control the company, we just appoint the board. And lastly, regulation. And those 5 external factors really will determine if, when and how we get to net zero. And I think it's fair to say that for the last 3 years, they've all gone a bit backwards. Consumption is not changing, the technology stack is improving, we're not seeing deployment fast enough. Market infrastructure, we now have the ISSB, let's hope we get it adopted, but carbon markets are not in a healthy place relative to where they were a couple of years ago. Corporate delivery is going backwards, and as you're probably all seeing as we go through an election process this year across the globe, we are seeing some policy walk back, which is making it difficult. But what did we commit to do then? Well, we committed to hold our portfolio companies to account, to pursue decarbonisation of their operations, continue to make venture and growth equity investments in the technologies that we'll need to get there, to scale the investment of green technologies as they become economic, and we can talk to some of those things we do there, but also to effectively use our balance sheet to acquire grey assets and actively decarbonise them. And we're very comfortable doing that. We were able to do it because we didn't join some of the industry conventions that were seeking to secure commitments for interim decarbonisation targets. And since we started doing this, there's multiple investments we've been able to make where we fully underwrote the comprehensive decarbonisation of the business before we invested. And those investments are all progressing very well. But one thing I will add is there's at least 8 auctions we've been in where we were the only bidder, but the transaction didn't close because the price that the seller wanted was too high relative to the fully underwritten cost of acquiring it, decarbonising it, and generating a return on investment. So I think there is still a disconnect between the market value or expected desired market value of grey assets and the price they may need to transact at in order to actually mobilise the capital to green them.
Amazing, thank you. And I probably talk about transition finance all day long. So it's a really kind of such a crucial area. So but very quickly, if we can go into Christopher, in terms of sustainable ventures, you're obviously involved in clean tech investment. And I guess where are you kind of focused in terms of technology and sectors, and what stage do you come into in the investment process, and where are the blockers, where are the opportunities?
Yeah, so I'm hopefully going to be on the more optimistic side on this panel, in that I do believe that the technical solutions and the business leaders to solve most of these problems exist. That's not to say that there aren't challenges to overcome. From our perspective, we invest across 5 key verticals, and those are food and agritech, building technology, mobility, future energy, and the circular economy. And that covers a pretty broad church, if I'm honest. The key for us is to have resource efficiency or some other core sustainable principle as the primary source of competitive advantage for the business in question. And by focusing on those businesses, we don't need to compromise between financial returns and impact. They're naturally aligned. We're not waiting for policy to drive change. We want to bring technologies to market now. Of particular interest over the last 12 months for us have been opportunities in alternative materials, everything from low-carbon concrete to plant-derived leather and smart glass. And at the same time, we've perhaps been doing a little bit less in mobility, digging around in the dirt as we do, as much the technology is more mature and, to be frank, for us, somewhat overvalued. In terms of stage, our focus is really beer mat to exit. We do work with entrepreneurs through the full life cycle for their businesses. But our focus is very much on the earliest stage. And we support concept stage ventures through our programs. We then invest at the pre-seed and seed stage. And we have our first late seed to Series A fund, hopefully coming later this year. And whilst this clearly isn't a financial promotion, we'd be delighted to talk to any prospective LP investors out there.
Fantastic. And Constance, obviously, you guys are a fair bit down your journey and stuff as well. If you can talk to us a bit about how you kind of work with your clients on the transition finance piece. I mean, I always do say when people kind of ask me why financial institutions, how quickly they're moving, why aren't they at net zero faster? I do kind of say that the whole finance industry could be net zero tomorrow if it wanted to be, if they just get rid of all of their customers. Obviously we might have some negative impacts on that in terms of the economy, and I'm not sure how everybody would like their mortgages getting dropped. So how do you actually work with customers on this journey?
Yeah, so I think, we're headquartered in Europe and in France, where we have a law enforcing us to be extremely vigilant when it comes to who we bank with. The first thing we do is we frame what we do and what we don't do. And compared to many banks, there's a substantial number of things we don't do. Typically, we don't finance new development when it comes to upstream oil and gas. We don't finance tobacco. We don't finance coal developers. So there's lots of things we don't. But within the framework of what we do, which is still a very large part of the economy, we engage with clients and we want to make sure we support them. So it's a matter of assessing where they are, where they want to go, the credibility of their pathway, and how we can support them within our commitment to net zero. And so as long as a client has a trajectory towards net zero, is really what we try to do is we have the luxury to have a very large institutional franchise, a very large corporate franchise, so we can support a full market development for our clients who want to invest in new technologies. We can support them in accelerating their investment in decarbonizing their activities. We can support them in M&A of new type of activities, which are going to be bringing them additionality in terms of business mix in a way where they can really take it to the next step in their decarbonization strategy. It's in the end, it's a matter of very much like investors engaging, understanding your clients, understanding their pathway, ensuring it's credible, and then going with them along this journey.
Thank you. And David, could you kind of expand a bit in terms of how UNEP-FI engages with its financial institutions around this subject of transition finance?
Yeah, so this has become a really active building site for us at UNEP-FI across a few different areas. One, as you might expect, is within the Net Zero Alliances with the publication of position papers from the Net Zero Banking Alliance, as well as guidance from one of the specific goals within the Net Zero Asset Owners Alliance framework, focuses on the quantitative transition finance and setting a target for that for institutions. So that part has, I think, been fairly well seen. What has really grown in the last 6 to 12 months has been the additional rigor of how do we begin to evaluate these things, and that's where some of the work that GFANS has done around things like the expected emissions reductions, the different 4 classifications of transition finance to those that are green, those that are greening, thinking about managed phase out. Those things have become, I think, a bit better parameterized, and so we're looking to adopt that. The other places, though, that are new for UNEP-FI have been considering the role that public finance plays with private finance. So even though it's a little bit more on the adaptation side, the work that the Adaptation and Resilience Investor Coalition has done, that UNEP-FI is the secretariat for, is really about thinking how do you mobilize funds for places that are needing to decarbonize, but also battling the effects of climate change, many of those in emerging economies. And then the last thing I'll say is we've also worked within the risk center that I had set up on the assessment of transition plans and the evaluation both of what risks they present, what does credibility look like. So in terms of potential concerns about greenwash, potential concerns about implementation, how do we move from evaluating plans just by are they complete to evaluating them much more specifically by do they really suggest a pathway that is feasible, that is desirable, and that is actionable for the institution. So we've been looking at that through a lens of assessing customer transition plans.
Fantastic, thank you. And just if it's okay, I'd actually like to go back a bit, Richard, to the comment that you made around carbon markets and the role that they're going to play. As a kind of, I'm aware, and part of my kind of day job is when it's open has been working in Parliament for quite a few years. And I think one of the things that I certainly notice, particularly with policymakers, is that carbon markets are even anything. There's almost an instant visceral reaction that that's probably greenwashing, and do we actually need them? As very in voluntary carbon markets credits, all this stuff. So can you just talk a bit about that kind of where you think that is now and the importance of the role that plays within the overall structure?
So fiduciaries respond to one of two things typically: regulation and economic incentive. And as we've seen, it's been relatively difficult to mobilize the policy stack we need to nudge businesses and consumers in the direction we need to over time. It took three attempts, but the European ETS, the European effectively carbon trading scheme, by the third cycle has now created a very, very real compliance market that provides an economic signal to European emitters to invest in decarbonisation. And the progress we're seeing there is considerable. And I said it took 3 attempts. Unfortunately, there were external shocks that effectively lowered emissions of carbon, depressing the price, requiring the system to be rebooted a couple of occasions. But I think we now have a clear precedent in Europe of how a compliance market can create that economic signal to emitters to effectively invest, because the alternative is to pay away to acquire the credits you need to emit, and that effectively now is reconciling it, making investments in the technologies needed economic. Now, the question then becomes, can we create a mechanism across other markets through voluntary carbon markets to deliver the same outcome? And there's several challenges, but I'd say they fall into 3. One of them is the integrity of the fiat commodity. This isn't a commodity. It's not a barrel of oil where you can see it, or a ton of aluminium. It's a hypothetical ton of carbon that is only worth the value of a ton of carbon if people believe it's actually a ton of removed or avoided carbon. And there has been, I'd say, precedent examples of the proof of that delivery of a ton of carbon less than desirable. And that has, I think, undermined some trust in the integrity of the market. A lot of work has been done over the last 3 years to provide guidance around there. So we now, I think, have a framework to give confidence to potential buyers and developers of these carbon assets what constitutes a marketable ton. The next challenge, though, is the adjustments that need to be made to a country's NDC, or its stock of carbon, if it starts to transfer title of carbon to other jurisdictions. These are called corresponding adjustments. They're enshrined in Article 6 of the Paris Agreement. Article 6 is proving the most difficult bit of Paris to conclude. We'll have another go at COP29 this year, but the integrity and the legitimacy of the transfer of that carbon across border is one thing I think that prospective buyers will want to have conviction in to avoid the double counting of carbon. The third is actually what is a legitimate use case for a corporate to buy a carbon credit and retire it. And that, I think, is a bit of a moving target. I think the appetite to do it has been compromised by, I think, prior concerns about the quality of the carbon. But more recently, I think multiple stakeholders are seeking to adjudicate over what is a legitimate use case to do it. The challenge of this is there's the micro angle of, is the company potentially greenwashing, and the macro angle of, is this company that is unable to economically abate in its own operations because the technology is not quite there, should it retain the optionality to compensate a rainforest nation for protecting its carbon sequestration resources? Because if we don't send them that economic signal to protect it, there is a very real risk they fell it. And that macro debate at the moment, I think, is been drowned out a little bit by the micro debate about the legitimacy of a corporate to participate in these actions to effectively compensate people for the provision of what are invaluable ecosystem services.
But maybe I'll step in because I think I concur with you. Maybe on the compliance market, I wanted to testify because 2 weeks ago I was in Berlin visiting one of the largest cement producers' green factory. It's absolutely amazing to see how the battle for green cement, green steel is happening in Europe thanks to compliance carbon market. It's really making it competitive and economically viable to invest in decarbonizing their operation. And it was mind-blowing to see Cemex taking every single bit of waste management, recycling, energy efficiency, leaving no stone unturned to get to something which is a 90% recycled cement and ready mix. So it's super, super interesting. And I think it's giving Europe a competitive advantage when it comes to future-proofing those heavy industries. When it comes to voluntary carbon markets, I'm very much in favor of voluntary carbon markets. I think if we do not rejuvenate those markets very fast, we're putting at risk a lot of the rainforest countries. There's lots of industries there who are really very keen to come get some land, operate on the land, and unfortunately, if we don't get the price of voluntary carbon markets back on track, we don't give a substantial incentive, economic incentive to those nations to keep the forest. So it's something which is a must-do, and for me, it's a core angle that we need to battle for at COP29.
Absolutely, and I think that was one of the kind of disappointments, wasn't it, COP28, that this was kind of left. David, do you have any thoughts on that, particularly around COP29's potential on this?
Yeah, so one of the big things as we look ahead to COP29 is the new quantified climate goal, and that really, you've heard it referred to in the press in different ways. Sometimes it's the $100 billion for climate, sometimes it's the share that the developed countries need to provide, but we know that that goal is nowhere near adequate. And we also know that it's taken over a decade to even reach the level that it was stated at back in Cancun over a decade ago. And so one of the questions is, how do we begin to get innovative with financing vehicles, with products, with the use of things like debt for nature swaps, like the use of the markets to allow people in other countries to continue growing while preserving the biodiversity by keeping carbon in the ground. And I think one of the key touch points is going to be, how do we work this out in a basis that also doesn't lead to other complications? Further debt, for example, over half the current financing has been in the form of debt and other instruments that have increased the debt loads in many countries that are already climate vulnerable. So I think part of this is going to be actually agreeing on the path forward between the developed world and many in the global south. But I think it'll also be for private actors a real recognition that we need to get innovative, we need to be thinking outside the box, and we need to get to scale. There's so many demonstration projects MDBs, DFIs have done. Now we're really at a point where I've sometimes said, we need sustainable finance to be boring. We need it to be retail mortgages. We need it to be something that can be done and repeated, because simply the transaction costs right now are often one of the biggest impediments.
I agree with you. So there's two things we can leverage on today. The first thing is the multi-development bank reform, which is enabling them to really accelerate and scale up development finance, and ensuring that we can provide interesting financing that have environmental or social components to emerging countries. One thing I would disagree with you with on is debt for nature swap. Debt for nature swaps are fantastic tool. However, they're extremely sophisticated and complex to scale up. So each swap, each solution may take 18 months, 24 months to execute. I'm not sure this is an instrument to scale up. If we really want to scale up, we need to rely on bond mechanism, something that the market knows, capital market knows. And typically, we're very much in favor of sustainable outcome bonds. There's one that got recently announced in the press. It's going to take a little bit more time, but we're working with the World Bank on a coral reef bond, which is designed to refinance a loan in Indonesia while protecting 3 natural coral reefs in Indonesia. The benefit with bonds, it's something which is extremely well known by investors. It will be a lot easier to distribute and therefore accelerate the industrialization of those solutions and the scale up.
Amazing, thank you. And Christopher, so you were saying that we don't want to, that you don't let kind of policy hold you back, per se. But from your perspective, what would actually really kind of incentivize or help accelerate the investments that you're doing, and probably accelerate the tech and the investment that we need for these solutions and all the innovation that is actually out there, because there is a fantastic amount of innovation out there.
Yeah, I mean, I think the first thing to say is that as early stage investors, we're pretty much allergic to existential regulatory risk. So we are just never going to get to a high enough degree of certainty over a future carbon price for us to be making investments on that basis. So for us, if your solution requires regulatory change or a long-term incentive to remain in place, then we're not interested at the end of the day. We need to see a pathway to commercial viability without a green premium and without ongoing regulatory support for the level of investments that we're making. And we're seeing those opportunities. We're seeing those opportunities in the thousands. Our investment team, small though they are, reviewed 1,400 requests over the last 12 months. So the early stage innovation is without question there. And for the most part, so is the pre-seed capital. We've seen a slight slowdown perhaps in the last 12 months with interest rates being where they are, but we've fared much better than the wider venture capital market, I'd say. All that said, I'm not saying that the early stage private sector doesn't need help. To start with, the really attractive pre-seed funding market we have in this country is in no small part down to the tax relief that's on offer, alongside the non-dilutive grant funding that the government has made available over the last decade. And the likes of EIS and the work of Innovate UK and the government-backed catapults are first rate and need to continue, first of all. What we need to see more of, in my opinion, is support a bit further up the pitch. So after proof of market, after proof of concept, but prior to full commercialization. All too often we're seeing our ventures running into a funding gap around Series B, around Series C, particularly those that are more capital intensive, hardware-led businesses, where they're getting to a point where venture debt would be much more appropriate for them than equity, but simply isn't available because the risk profile just doesn't quite work as it currently stands. So my biggest request, I think, to the future government in this country, whoever that may be, is that I would love to see a bold initiative to underwrite first-of-a-kind venture debt in the climate tech sector. And I think we'll find that the capital risk isn't quite as high as people think it is.
If I can just build on this, so what do we need to make some of the bold transformation investments we clearly need to do? It's really three things: policy certainty, clarity about the carbon price, and clarity about future cost curves. Because that is going to help us underwrite the fan of potential outcomes on those investment returns. And it's not that we need it to be 15% plus or minus 1%. What we need to work out is how do we take zero out of the distribution. We don't need 10,000%, but we would like to see some risk-adjusted returns that allow us to deploy at scale. And I think you're just building upon there. One of the, I think, big challenges in the capital markets today is that the whole investment community, I think, is conditioned from 35 years worth of venture and growth investment in technology. These were IP-heavy, capital-like businesses, and as they went through the different seed rounds, there was never the notion that I can get from the university into a pilot for 150 million, but the next first of a kind requires 2 billion. It was, I'll raise 5, 20, 50, maybe 100, and maybe the next time I raise will be $20 billion at the IPO. And that model is really quite a contrast of what we've all become accustomed to over the last few decades. The other thing I'd say is the technology industry was lending itself to net returns in excess of 20% per annum. And I think what we're likely to see as some of these things move beyond that proof of concept and move into beyond the first of a kind is they may start to look more like industrial rates of return because they are generating returns on real assets. And there is, I think, a real debate to be had about what scale, what fee structure, and what expected returns should we really now expect of an emerging asset class that is the climate tech growth investor. We've all seen the numbers, how much needs to be invested, but if you want a diversified portfolio of investments that are in the CD arena that may need to be $2 billion each, you need diversification effect. You start to look at needing potentially a cohort of institutions that have $50 billion of assets each, possibly generate gross returns in the mid-teens, probably therefore are not charging 2 and 20, which is where we've been accustomed to, but are able to deploy at scale into effectively retooling the economy. But we seem some way away from there today in terms of the later stage growth community in climate tech.
And does that kind of create any conflict just in terms of your fiduciary duty? I mean, back to your kind of objectives of maximizing your shareholder return?
No, at the moment, look, we where we identify great businesses that can scale are able to invest directly or indirectly with or even alongside our GP partners. What I say at the moment, though, is that there is definitely a dynamic that real innovation is taking place in universities and beyond. It is getting to the point where it is able to deliver, as you've just heard an example of there, something like a CEMEX renewable plant, but not inside a large corporate venture group. This is actually genuine private venture seeking to finance a multi-billion-dollar investment. That the ecosystem to support that is not as mature as the opportunity set is becoming.
And I think one of the interesting things, I think everybody here probably works on a fairly global basis as well. And again, having, as we're going through this transition and we're redefining value and potentially what fiduciary duty actually means in the long termism, obviously kind of how financial centers and how international regulators correspond with each other is going to be incredibly important. So, David, I mean, what's UNEP-FI kind of, what's your kind of take on this, and what do you think some of the big opportunities and barriers are here?
Yeah, so I think, we heard a number of these pieces, and it's interesting because this notion that we need things that are in the infrastructure side, what we'd call shovel ready, but we hear consistently from the major financial institutions, we need policy action. That's also true, but it's interesting to see as you kind of look across the entire capital life cycle from the early stage on, where that actually trickles down to. And so a lot of that is really in that deployment at scale. I think it's also realizing something that isn't fully appreciated, which is this isn't going to just simply be a switch of one set of business activities for another. This is really a fundamental change. I don't know who's seen Indiana Jones, where he's in the temple and he switches the idol, and it looks like it's okay for a moment, and then it all starts crumbling. But the truth is, we're not doing that exercise. What we're trying to do here is think about, in many cases, younger companies, in many cases, more complex technological processes. And I think across the value chain, going from those that are starting with smaller companies that they work with all the way up to bigger institutions, there needs to be a reappraisal of risk and a real understanding that these things are going to look different. And the upside of that is, I think, a lot of things that we haven't done to date in countries, in technologies, we are way overrating the risk because we just don't have the data, we don't have the experience, and that is a huge area of arbitrage. On the flip side, I think these are going to be slightly riskier times. We're going to run economies hotter, we're going to see more need for intervention, we're going to see a number of things that mean that if you're not grappling with this from a risk standpoint, you can have the best transition plan in the world, you can have the best desire to finance the transition, but where the impact is happening, you're not going to be able to play.
And it's an interesting point, isn't it? Because ultimately, all of our regulation is very much based on what's happened before and trying to kind of learn from the past experiences and trying to lock down that and kind of keep out that, particularly that systemic risk, as much as possible. And we're very much having to kind of fly the plane as we build it now. And so in terms of like financial institutions, is that a hindrance? Do we need to start looking at this risk, or is that something that almost the central banks kind of keep their risk profiles as they are, and then it's for governments to kind of come in and take a slice of that, or is it a fundamental, I guess, readjustment of what risk looks like, and how much is climate change, do you find, actually really getting incorporated into that kind of primary regulation?
So maybe I'll just say a few quick words, just working with a large number of regulators. I would say it's increasingly rising up the regulatory agenda. We've, of course, seen climate stress tests. Many of you are very aware of the climate disclosures that are required in a growing number of jurisdictions. But I think this question of how do you actually facilitate transition finance, this is one that the regulatory apparatus isn't so far along. We see more of this taking place via fiscal policy in the Inflation Reduction Act in the US, Fit for 55 in Europe, the commitment here in Britain to innovate, but at the same time, I think what we're kind of struggling with on this is it won't simply be a top-down mandate. And while we've talked about things like capital weights for fossil fuels or green assets, there's always unintended consequences, and so we need to be thoughtful, not to just create green asset bubbles, but for each institution to really make a really thoughtful case for their own strengths as well as their own areas of lack of knowledge, where they say, this is kind of what we need to be doing and where we need to be. As I said, so much of this financing in emerging economies isn't doable under the current risk appetites that many financial institutions have. It's not really going to be, unfortunately, a top-down approach that will say, oh, magically that'll happen. It's really going to have to be within each of those boardrooms, within each of those committees to make those choices if you want to do stuff differently.
Yeah, I think we need to be careful, though, not to conflate macro and micro. So, look, there is a risk in emerging markets of things happen, currencies collapse, and that's hard to underwrite. The issue we're confronting today, though, is not that. It's actually the challenges we're having in underwriting relatively more mature technologies in developed markets. And what I'd say has happened across many of the technology stacks we're looking at now is the costs of technology have fallen so much that we've seen a massive demand response, but we haven't seen the commensurate investment in the supply chain. So today, we're currently working with EDF to build 5 of the 8 offshore wind farms in France. We have a supply chain in place, these projects are moving forward, but as the next generation of offshore wind is seeking to be built, we're finding ourselves that we don't have ports that are tooled to be able to effectively support offshore operations for offshore wind. We don't have ships that are actually been built yet to be able to help us lay. We don't have access to the copper cable we need to connect the offshore wind farm back to the land. We're not able to get the turbines we need in the quantity we need. And importantly, on land, the local communities are not actually as responsive as we might want them to be to having a major, effectively connection to an offshore wind farm and maybe even offshore wind farms on the horizon. As soon as this power's ashore, we then need to actually ensure that it can be added to the grid, which requires massive investments in incorporating an increased percentage of effectively intermittent power. And that in turn requires other local investments to be made, where we are seeing effectively a growing increase in effectively anti-green NIMBYism. Now, those are all fundamental infrastructure underwriting risks that we've been accustomed to as we built toll roads and rail lines and power infrastructure for many years. But the pace of deployment that we need, the permitting support we need, the support we need in actually providing appropriate incentives to communities for effectively helping getting them on board, copper mines, engineers, smelting yards. These are things that the developed markets have not really invested in for a half of a century. But we will not be able to deliver the capex and the deployment and capacity we need unless we get metal, fabrication capabilities and people in the economy to help deploy at scale pretty quickly.
No, I totally concur with you. I think the trick for me is to be able to grow all those legs, all those pillars at the same time. Typically, when I was in Berlin, the Germans were telling us that there is more than enough renewable power, but actually it cannot get into the grid because there's been a lack of investment into the grid system. So today you land into absurd circumstances where you have everything except for one little bit, which basically prevents the system to be fully green. So I think being able to work on all the levers, and that includes a lot of the permitting and a lot of the government infrastructure. When I mean by government infrastructure, like a tower control, which is really enabling to unlock situations and ensuring that everything grows at the same pace, is absolutely crucial. I think the pace has accelerated. What we're trying to do is redesign entirely an infrastructure in a couple of decades when it took us 100 years to build. And that's what makes sometimes risk departments a little bit more wary. It's because they're not used to this pace. So it's a matter of, it's not rethinking the risk, it's rethinking the time horizon of risks, which is something we're not used to do.
Absolutely. So I'm glad you met that. So apologies to anybody in here that's heard me kind of speak before, and apologies to Dave because he's heard this probably 50 times. But my favorite fun fact is that 1494 was our first book on modern accounting. So we've had just over 500 and a bit years where we've ascertained what value is, and we kind of got it down to a nice P&L and a balance sheet and a cash flow forecast and a bit of a business plan. And in a matter of years, not even decades right now, we're kind of fundamentally trying to, nature and biodiversity loss and climate change have never been part of that equation, and we're trying to quickly put that in and change. But in the meantime, all of our laws, all of our regulations have been built over centuries on a different value structure. So actually there's certainly from my perspective a case for just having to do things differently now. And I think what's given me a heart over the last few years in particular is that is just the acceleration and the rate of change, even since COP26. I mean, it's been an absolute game changer in terms of how the private sector has engaged and starting to properly engage with governments and whatnot. And it's kind of a different way of working together. So I personally find that very exciting. So just we've just got a few minutes left. So I was just hoping to go to each of our panelists here and kind of say, so we've talked about the fact that we need to go at pace. We've got this urgency. We need to work differently. The money's there. We all know that there's cash there. Governments don't have it. It needs to be, the solutions are going to be coming through the flow of private capital. What's your wish list? What's the kind of top one or two things on your wish list that you think would be absolutely game changers to get this moving, whether that can be in either emerging technologies or regulations or laws or anything. And I'll start in here, Christopher.
So I've got a long shopping list that I won't run through all of. Firstly, though, I'm sorry to go political after a really lovely chat, but I think probably top of the list is an outcome in the US presidential election in the autumn, which doesn't make everything immeasurably harder on that side of the Atlantic, and by extension across the world. Secondly, as I mentioned earlier, a commitment from the UK government to look at government-backed venture debt for first-of-a-kind projects in this country. And thirdly and finally, most wishfully, I'd like to see a breakthrough in sustainable long-haul aviation, which opens up this wonderful world to a generation that I think are feeling increasingly trapped by the climate crisis.
Yeah, so I worry that we're in a place today where the systems overseers, the boardrooms and the investment committees of the world have not yet attained a state that I'll call sustainable or climate aware by design. I'm not sure we can say they're climate ignorant, but we are clearly not at that end stage where it's climate aware by design. And that would be my wish list, that if the people responsible for oversight of the system, every boardroom and every investment committee was systematically considering sustainability and climate when they developed their strategy, pursued its operational implementation, and communicated with the stakeholders around them, I think we'll be a lot closer to where we need to be.
Amazing, thank you. Constance.
So I'm going to try to be complimentary. We need a positive mindset, a positive culture from the media. Today it seems that whatever we do, it's either not enough or too much. So it's between greenwashing, it has become a nightmare. And I think this has been freezing a lot of what could go faster in a more bold way. So we need positive people, we need a positive mindset that accompany transition, even if it's imperfect, it still goes in the right direction.
I think we need an all-hands-on-deck effort. Politically, I think that this is a decisive year, not just in the US, but globally, for getting that political leadership. I think on the financial side, we need to have that awareness that Richard was mentioning, from leadership and really seeing this not just as something that regulators are pushing, but really this is a sea change. This is a change in the operating system of business, and that needs to come through. And on the tech side, it's just so awesome to see all of these technologies developing. I think we also really need to see things that will allow that to get into the marketplace. So on that regulatory side, the point that you made about Germany, I've also heard in the US that the US has enough renewable capacity that is currently waiting in queue to meet its 2030 goals, and yet there's no chance of that actually getting there because just the sheer red tape, the interconnection challenges. And so it's starting to say, we do have all the solutions, but where's the blocker? And really being relentless about knocking those blockers down.
Amazing, thank you. Well, thank you everybody for your time today, and to the panel for your time. Been a fantastic discussion, and I hope everybody enjoys the rest of their day.